All right, guys.
Hey,
There we
Darren.
go. Man,
GM.
Jim, brother.
So you got your FXRP ready for tomorrow?
Oh, yeah.
This bro. This bro.
Yeah. I've been ready for like a year now. So, yeah. All right. So, you posted on Telegram that there's still a lot of moving pieces, before you can have like an exact launch. Can you share with us where you are and how do you expect the launch to go on?
Yeah, so we're doing final lineup right now. We've tested everything. We've done a couple deployment tests on Coston 2. We have deployed a fake test version on Flare. Gotten all of our infra set up, integrated with HyperNative, got our Dune dashboard set up. So the process for tomorrow will be doing all of that again and just moving everything over. It does take a little bit because we have to launch all the contracts. We have to deploy the subgraph. We've got to get everything switched over, get the front end up, get pools set up on DexV3 and all of that. Not entirely sure how long that will take. But the reason we don't just go ahead and launch everything now is that one of the features of launch is that it launches with redemption protection. So the redemption rate starts at 100%, meaning it's impossible to profitably redeem. And that rate decays over time until it reaches the base level after about 46 hours. So we want to do everything as fast as possible and get it out there, but we can't do too much ahead of time because once we launch the contracts, that countdown starts. So the idea behind that is that what you don't want to have happen is for people to be creating troves and then selling CDP, which would then cause the relative price of CDP to drop before liquidity builds, meaning people are buying it cheap and redeeming it out. So then you have a battle between growth trying to happen in the protocol and that value being redeemed out at the same time because people are selling their CDP before you get enough liquidity built. So we need to try to get that done all at once, so that there's time for that liquidity to build, so that there's enough liquidity to keep the price stable, so that we don't have redemptions off the bat.
Okay, yeah, that's very nice. So, can we explain what redemptions is for anyone that is new here?
Yeah, so the redemption, in order to keep the price pegged at $1, you need the ability to purchase CDP when it goes below $1 and get the underlying value out of it, right? Because it can always be, a redemption is where you take CDP dollars and you redeem it for the underlying. There's a base rate of 0.5% as a fee built into that. So it's never directly 1-to-1. But basically you can take CDP dollars if the value dips, and you can buy those and you can then go to the protocol and redeem that for the underlying collateral. So you would get either wrapped flare or FXRP or a combination of both of those depending on a few factors. But that way it keeps the price pegged to $1 as close as it can. Obviously the value of CDP on chain depends on what people are doing, buying and selling it. So it's never going to be pegged like precisely to $1 all the time. It's going to have fluctuations. If somebody comes along and sells a whole bunch of it, the price will dip, but the redemptions allow an arbitrage reason to purchase it when it's underpriced, and you can redeem it for the value immediately, or you can wait for the value to go back if somebody else redeems some, to then just be able to trade it back. So the redemptions, the redemption process is based on two main factors. Troves that have a lower interest rate are considered riskier by the protocol, and so those will be targeted first for redemption. And also, whichever collateral branch has the lowest ratio of CDP in the stability pool for that branch versus the amount minted. So if you have a lower ratio of CDP in the stability pool to minted for, say, the FXRP branch, then lower interest rate troves in the FXRP branch would be targeted first for redemptions. If you are redeemed against, what that means is someone comes along and pays off your debt and takes your collateral in return for that. So if someone redeems $100 worth of CDP, and your trove is the only one that gets hit with that, what would happen is your debt would be reduced by 100 CDP, and $99.5 worth of FXRP would be paid to them, and that would come out of your collateral. So you would technically make a 0.5%, at least a 0.5% gain on that, relative to your collateral to debt ratio. But that does reduce your collateral. So you would have less FXRP. Of course, you could then take out more debt and buy back FXRP, and you would end up at a net gain. But that is something that you'll see happen to your troves if you're on the lower interest rate side. That's what helps the market find a balance of where a good interest rate is, because there's competition between taking more risk, but also getting a lower interest rate versus taking less risk but having a higher interest rate.
And then redemptions are neutral for the people that are supplying collateral, right? Because when you have a liquidation, that means that the price is going down, so you need to basically sell more of your collateral to pay back your debt or to cover your debt. But when it's redemption, it has nothing to do with the price of the collateral. It's just the price of the CDP.
Correct. Yeah. Redemptions have nothing to do with the price of collateral, and it's at least neutral. It's technically a net gain. Like if everything stays the same and somebody redeems, you technically have a net gain because you've had 100 of your CDP paid off and only $99.5 worth of your collateral taken. So you've technically made a 50-cent gain there. So it's at least a net neutral. If there are lots of redemptions that happen, then the redemption rate will go up to where it actually becomes more and more of a gain for you on net. That does reduce your exposure to the underlying collateral though. So if we're in an uptrend of the market, then you would want to readjust that, to get back your collateral, assuming that you're wanting to regain your exposure to the underlying asset.
Okay, yeah, that explains it pretty well. So yesterday you made a post and you're talking that the minimal collateral ratio for FXRP is 110, so 90% LTV, but the critical collateral ratio is 150. So that means that the actual LTV is going to be closer to 50%, or can you explain that further, please?
Yeah. So for an individual loan, the minimal ratio is 110. That's your liquidation point. So if your individual loan hits 110 or 90.91 LTV, that's when you get liquidated. If you do get liquidated, you pay a 5% liquidation penalty, and you can reclaim the other 5% on an FXRP loan. For the wrapped flare side, it's 120% to hit liquidation, but you still only pay the 5% liquidation fee. So you would then be able to reclaim 15% of your collateral. Those numbers aren't exact because it's technically based on having 120%. It wouldn't actually be 15% of your collateral. It would be 14%. But anyway, yeah. So the critical collateral ratio is a branch level number. So the protocol itself wants to maintain an over collateralization of greater than 150% for the FXRP and greater than 160% for the wrapped flare side. If it dips under that, meaning there's less than 150% collateral ratio for the entire branch, then there's some restrictions in place that come into play that kind of stop people from lowering that ratio further. It means that you would not be able to take out more debt if that would lower the collateral ratio, and you would only be able to open a new loan if it's going to bring that total collateral ratio back above that point. That's just to have a safety buffer for the protocol itself to stop it from spiraling.
Yeah, that makes sense. I mean, FXRP is a new asset and we're still in the early stages of liquidity. So for sure, there has to be some safety measures. So Darren, go ahead, Steve.
Yeah, hey guys, just so you know, if this is going to be an open AMA, so obviously we're asking some questions to kind of get the ball rolling. But if you have any questions, feel free to message us or request to come up on stage. We'll let you ask Darren questions about the protocol to get a better understanding. Also, do like and share this, guys, so we can get out to as many people as possible and let them learn about this amazing new opportunity for borrowing and lending. So,
thank you, Steve. So Darren, if you had to talk to the different users, who would use like a traditional borrowing and lending, and who would be an ideal user for CDPs?
So it's not necessarily different users. They're kind of different reasons to use each one. But the main differences are who your counterparty is and what the kind of risk profile is. So on a traditional lend borrow like Kinetic, what the protocol is doing is matching up lenders and borrowers, right? Kinetic doesn't actually hold any assets. It doesn't create any assets. It's saying, here's some people willing to lend. Here are some people willing to borrow, and it's matching those people up. The interest rates on something like Kinetic change over time based on how much borrowing is happening versus what's available to lend. On loans, the interest rate is set by the users themselves. You're not going to be subject to your interest rate increasing over time if more people borrow, which is one of the kind of main perks of it, is that you're in control of what you're paying as far as your interest rate. There are risks involved with that, like the redemption risk, but you're in control of that at all times. There's no unexpected spikes in interest rates. So it's a similar function as far as being able to borrow against your assets. But you're also effectively lending to yourself. The protocol itself is the counterparty. And so there is no counterparty on the other end. So on what that means is that you constantly have the ability to pay off your own debt and recover your assets. One of the things that can happen on a traditional lend borrow is that if the amount of borrowing goes high enough, versus the collateral that's available, that collateral can effectively be locked because you have now lent your assets to someone else. And you have to wait for them to pay back their loan before you can recover your assets. In loans, that's not the case. You can always pay off your own debt to recover your own collateral.
Okay, yeah, that's a very good distinction. Thank you for that, Darren. And then we are supporting Rappler and FXRP at launch, right? Like at some point tomorrow, we'll be able to create loans from that, correct? And then what are your plans for SFlare and Staked XRP?
Yeah, so now that Staked XRP is on the FTSO, we're going to watch that for a little bit, make sure that that price feed is working correctly. And then we'll be adding Staked XRP relatively quickly after we launch. We'll see how the launch goes. We'll see what the demand's like, and then we'll be adding Staked XRP. At some point following that, we'll be adding Staked Flare. I'm not sure when we'll do that. It might be relatively soon. We might wait until the end of Flare drops to kind of see what impact that has on Scepter before we add SFlare. Because one of the issues with SFlare as a collateral asset is that it's effectively price leveraged Flare. So any price impacts that happen to Flare will happen in a larger magnitude to S-Flare, because S-Flare is basically 1.7 Flare right now. So any price change in Flare is going to have a 1.7x price change in S-Flare, which makes it a more volatile asset, because any volatility in Flare is magnified price-wise on S-Flare. But we do intend to add both of those assets through time. We don't have plans to add anything beyond that right now. Obviously, as new assets come on chain to Flare, we'll be looking at them. Would love to get something like Tether Gold, XAU, T0 brought onto Flare, and we could add something like that, because that's obviously, a very deep value asset that's tied to the price of gold. So it's going to be less volatile than a lot of things. And then in the future, when FBTC and things like that come on, we'll be looking at adding those. We're not intending to add riskier assets. We're really wanting this to be backed by, deep liquidity, blue chip type assets.
Is there a reason that you can't mint a stablecoin with ETH, for example?
We could. I mean, we could add Stargate bridged ETH or our bridged ETH, but borrowing against ETH is something that's pretty readily available. Not on Flare, but it's readily available on ETH all over the place. So there's kind of less of an addressable market there, and generally, people on Flare don't hold a lot of ETH. So it would effectively be giving people a reason to go buy ETH and bring it onto Flare. And whether we'd rather do that or whether just further incentivize, more FXRP coming on, I personally would rather we see more FXRP than see more ETH come onto Flare.
Totally agree. Yeah, I agree. So, on the post that you made yesterday as well, you gave a little warning about trying to do big swaps from CDP into another stablecoin. Can you explain a little bit how markets are created at the very beginning? Because I see that is people get excited and then they do big swaps and they end up losing money and giving opportunity for somebody else. So what's your expectation of how that market will evolve over the first maybe week?
Yeah, so the first pair that we're going to have on DexP3 is going to be a CDP to USDT0 pair. We need as much stable liquidity as we can get as quickly as possible. Once that kind of level is established, then people can start more easily doing things like using CDP for leverage, right? Like you mint some CDP, you go swap it for another asset or you swap it for FXRP or Flare and add that to your collateral, and now you've leveraged up. Technically the protocol can do about 11x leverage before you run out of any edge there above the 110%. But doing that in the beginning is going to lead to losses if you are quickly selling your CDP, because it's not going to have enough liquidity to support that initially until we get enough liquidity in the pools. And if you do too much of that, it's going to lead to redemptions. So we can't stop people from doing that. Obviously, you can do it if you want to. My advice would be to pay attention to what you're doing though, and pay attention to the rates that you're swapping at. Because if you're going to make an unfavorable swap to where you're losing, 2% on the swap, whether that's going to end up being worth it, it's hard to say. In the other direction, kind of similar thing. If you're not looking to mint your own CDP and instead are trying to buy it, just pay attention to what you're paying for it. Because if you're overpaying for it, one, the price is probably going to go back down because someone's going to mint and sell because they're going to see, hey, I can mint this $1 and sell it for, $1.02, and I just made 2%. So if you're trying to buy in, I would just pay attention to the liquidity, make sure you're not pushing that price up the liquidity curve too much with your trades. But also in general, my advice in almost every situation is to not buy into something to try to chase yield. That tends to get people hurt. They get excited because they see big numbers, and so they want to jump in right away. One thing to remember about APRs and stuff like that is that they're a function of the amount of reward over the amount earning the reward. And as the amount earning that reward goes up, that APR goes down. So you're going to see big numbers in the beginning because the amount being rewarded is static, but those numbers will go down over time because the amount earning the reward will continually increase.
For sure. And then we have the stability pools, and then we would have the liquidity pools on Enosys. Can you explain what is the difference between those two, please?
Yeah, so the stability pool is what's used in case of liquidations on the loans protocol itself. Each branch has its own stability pool. If you go to the front end that's up right now on Coston, you'll find those under the Earn tab. Those are the stability pools. And what those do is, one, you deposit your CDP into those, and you begin earning 75% of the fees earned by the protocol. So all of those interest fees that are being paid, the mint fees that are being paid, 75% of that goes to the stability pool of that branch. So all of the fees that are being paid from the FXRP branch, 75% of those go to the FXRP stability pool. Those are paid in CDP. They're not paid in the underlying collateral because the debt is being accumulated as interest. The interest is being accumulated as debt, and that's paid to the stability pools. In case of liquidations, your CDP in the stability pool would be burned to pay the debt, and you would earn the total amount of your CDP that was burned plus 5% in the underlying collateral. So if 100 CDP of your stake in the FXRP stability pool gets burned in a liquidation, you would earn $105 worth of FXRP in collateral that's claimable through the stability pool. We need a good amount of CDP in those stability pools to keep things stable in case of liquidations. And so not only will you be earning the interest and mint fees, not only will you be earning the liquidation rewards in case of liquidation, but we'll also be providing incentives for both of those stability pools in our Flare from the Flare Foundation, and we'll be providing our own AppSys incentives as well. So we're trying to keep those pretty incentivized so that we keep enough CDP in there to keep things stable and give people a reason to take the risk early. We generally see incentives as not only a way to get people to come participate in something, but also a way to kind of help with some of the risk of participating early and doing things that do have a risk involved. Obviously, taking debt against your collateral has a risk involved with that. You've got the risk of redemption and you've got the risk of liquidation. And so we try to defray some of that risk with incentives. And so there will be rFlare, there will be AppSys as incentives. And you'll also be earning the interest, the mint fees, and any liquidation rewards that happen. I mean, hopefully nobody gets liquidated because hopefully stuff just goes up. That would be great. But, you know, in case of liquidations, that's what your CDP is in the stability pool for.
And then the process would be you can mint CDP and then deposit directly into the stability pool. Like you don't have to do any swaps or anything. So that, in theory, should be a pretty low risk move, at least at the beginning, right?
Yeah, correct. And in that case, like if you were to take all of the CDP that you mint and put in the stability pool, you'll be earning back the majority of what you're paying in interest. So basically you'll be paying yourself the interest to borrow, and earning incentives on top of that. So it's a pretty low fee, low cost, thing to do. Of course, then you're just minting to provide stability and you're not doing anything with your CDP other than that, which is fine to do. That helps the protocol grow. And basically what you're contributing in that case is you're contributing stability to the protocol itself.
For sure. I mean, there's different risk levels, and I think that is like if somebody's trying to participate and support the ecosystem without taking too much risk, that could be a good move to get yourself like comfortable with the protocol. Thank you, Darren.
Yep.
Hey, Flare community, welcome. Do you want to participate?
Hey guys, yeah, thanks for hosting. I think you've already given
Hey,
quite
John.
a good overview. I just wanted to ask what the ticker symbol would be for the stablecoin.
Yeah, so it's going to be called CDP Dollar, and the symbol will be CDP. We tossed around a lot of names, just kind of decided to avoid things that were US dollar centric. And the name's kind of self-explanatory. Like, it is what it is. It's a CDP, and this is the CDP Dollar.
Perfect. I mean, you've already given quite a good overview, I must say. But I think it could be a good opportunity for you, Darren, to maybe talk a little bit about your favorite hashtag, which is, don't push buttons if you don't know what they do, right? Because there's a lot of people that participate in dApps and they get caught in a sticky situation and it's not what they expect, mainly because they haven't learnt about the protocol itself. And then, they start pointing fingers, blaming the protocol and whatnot. But I think it's important to understand what you're doing before you participate. Maybe you can elaborate on that a little bit.
Yeah, I mean, that's one of the beautiful things about DeFi is that everyone can participate in it. There are no blockers to using contracts that are on the network. There can sometimes be blockers to using front ends, like geofencing and things like that. But there are no blockers to using the contracts that are on a network. However, even though the use of those products might be simplified through a nice user experience, a good UI, it doesn't necessarily mean that what the product is doing and what your assets are doing is a simple thing. These are relatively complex interactions that happen on both a contract and a market level, that if you don't understand how they work and you don't understand kind of what the edge cases can be for some of these things, you can end up in situations where you don't know what's going on, you don't know how to react, you panic and you make moves that you shouldn't do, and you end up pushing buttons that you don't know what they do. I've seen that time and time and time again, where someone goes in, they see someone say, "Hey, you should go try this thing." They go look at it, they're like, "Wow, look at all that yield I could earn," and they jump in there, and then a day later they're looking and they're like, "Wait, this doesn't look like what I expected. What happened? Something must have gone wrong, or someone took my money or something." And really the protocol did exactly what it was supposed to do. It did exactly what it was expected to do. You just didn't know what to expect. So my advice always with these things is, one, test them. We leave all of our products up on Coston, Coston 2, on Songbird, the ones that are there. There are lots of places to go to dip your toes into things with lower value. Also, there's never a reason to rush in, jump in. As I said, the yields always look really high in the beginning, but that's just a function of math. Those yields will go down. They will stabilize somewhere, and then they'll fluctuate around that. Jumping in at the very beginning when it says, 10,000% APR does not mean you're going to get 10,000% APR. It's not a real number. It's just a function of math. That number will go down, and it'll settle somewhere that's more realistic. Jumping in with both feet into something you don't understand to try to chase that yield will tend to incur losses that are going to be above whatever minimal gain you got by getting in super early. So start small, make sure you understand what you're doing, read the docs, take those docs to Grok or ChatGPT and really go back and forth until you understand it. Treat DeFi the way you would treat anything in TradFi, where you're going to want to make sure you understand what you're doing before you sign your name to something, because sending a transaction from your wallet to a contract is effectively signing your name onto something. The contract's going to do what it's going to do, regardless of what you think after that point, until you take your funds back out. So treat these as financial interactions, financial decisions that you're making, and make sure you understand what you're doing before you do it.
For sure. I mean, I feel like the Flare network at the beginning was kind of like a playground where we could try things, but now it's becoming a very serious financial instrument, and I couldn't agree more. People need to really take this seriously.
Yeah, and if you do, you'll find that you're gaining knowledge in something that lets you use your time, your knowledge, and your money to do something useful with that money that tends to earn you some sort of reward, whether that's in incentives, whether that's in fees. The more it lets you use your assets that would otherwise just be sitting there to do something useful for others, to help them have a better trading experience, a better market experience, and you get rewarded for that. It's the same sort of services that your banks and your market makers and your trading institutions, like those are the same services that they provide, and you get to do that yourself. But it doesn't mean it's simple. It just means it's open. It's open to you to do. It doesn't mean it's simple to do.
Yeah, for sure. I think DeFi, I've been saying this, that DeFi empowers users, but does not force them to do the right decisions.
Correct.
And then can you explain how Enosys loans will benefit the APY Cloud?
Yeah. So 5% of all of the fees being earned, the protocol revenue, so that's in fees and mint fees. I think there's a small portion of the redemption and liquidation fee gets paid to the APY Cloud every 24 hours. That'll be claimed. And that will go to HLN and Apsis stakers in our governance. This is kind of a big move in that product ecosystem. It's what we were waiting for before we launched the APY Cloud, was for loans to be ready. Because the idea behind the APY Cloud is to properly align incentives between the market, our users, governance, and the team. So it's a flywheel to where the more volume that we get on our products, the more fees those products are earning, means the higher fees that are being paid to the APY Cloud, which means the more governance has importance in the ecosystem. And so we incentivize that governance to try to align governance votes and governance actions to further increase that volume and that yield. So yeah, it'll be plugged straight in. Governance stakers with their HLN and Apsis will start earning CDP within, I think, the first 24 hours. It should start flowing in. And yeah, you'll see that show up on your list of assets alongside all of the rest of them that are being earned from DEX V2, DEX V3, the bridge, and that'll be added to the list, and we'll see what that looks like. I mean, it should be relatively profitable for the APY Cloud and for our governance stakers.
For sure, especially if you're doing liquidity pools and getting Apsis, and then that Apsis is being compounded into the APY Cloud. That's pretty much what I've been doing, and it's been really nice.
Awesome.
And then, guys, anybody has a question? I can't believe that the 40-something people that we have no questions. Please either put them in the comments or request to speak. John, do you have any other questions? Steve?
I think you robbed all my good questions.
I do have a curiosity question, just because I've been doing a little bit of building. How many smart contracts did you put together to make all that work?
Oh, wow. A lot, and a lot of iterations of everything. Yeah, I mean, the APY Cloud itself is a full system of, we've got the entire governance system, which has the contracts that are tracking the stakes and tracking value and rewards. We've got the fee collectors, where each protocol is paying a certain amount to a collector that's splitting those fees out. There's a lot to it. And those systems are all set up to automatically do things. So all the fees are being automatically claimed based on other user inputs. So like we need governance staking to happen in order for fees to be claimed, for that to all be fed in. It's pulling pricing from places to know how much to pay out and how to divide it out between HLN and Apsys. I mean, there's a lot. And the APY Cloud is something that we built completely from scratch. Most other things that we've launched have been at least built off of something else, and then we've added things to it or taken things out or changed some things on how they work. But the APY Cloud we built completely from scratch. And I think it's a great system. Personally, it's what I've been looking for in DeFi for a long time, which is part of why I joined the team, is that the idea of the APY Cloud being a flywheel and pushing that revenue from the ecosystem back to participants and back to governance stakers. I think it's just a nice addition to what DeFi systems can look like.
Oh, for sure. Like I've gotten really active in gobbling up Apsys and HLN that I was not previously, because it just wasn't all there yet. But now it's starting to look like just a beautiful ecosystem, man. Just incredible.
Appreciate it.
Well, guys, if no one else has any questions, there's another question here. Hold on. But we are thinking about doing a live stream at the end of the week, and we'll do a demo on how to mint and everything just once we're live. So yeah, let us know if you have any other questions, guys.
All right. Well, if there are no other questions, guys, have a wonderful day. Darren, man, thank you for joining us to help us with this pre-launch, kind of get some people some information out there. And then we'll track you down for some more information after we've kind of got it live and done some testing, man. Super excited.
Sounds like a plan. Awesome. Tomorrow should be fun.
There's one more question, Darren. Will the CDP eventually go on a different wallets or exchanges, DEX, that will benefit the Enosys Flare network overall?
Well, I mean, CDP will be on DEX v3. As far as growing it from there, we need the protocol to grow first. We're going to focus on DEX, DeFi, on-chain, building that liquidity first. If it gets big enough, then we can look at doing things like centralized exchange listings and growing it beyond that. But for now, our focus is just growing it within the Flare network and within our ecosystem and others on the Flare network for now.
Yeah, that makes sense. And then lastly, you will have incentives for the CDP USDT pool. What about like CDP
Yes.
FXRP or CDP Rappler? Would that be considered, maybe not right now, but in the near future?
Yeah, eventually we will probably add that. For now, the stable liquidity pool will be enough because on DEX v3, the trades will route through that pool anyway. But we really want that one-to-one liquidity built up first, and then we can look at adding some other things. But adding in those pools to start would just increase the arbitrage as the prices for wrapped flare and FXRP move. It would just provide arbitrage for bots. So rather than give a bunch of arbitrage to bots, we'd rather build up the one-to-one value, and then we'll look at adding some other pools.
Awesome. Master, I think your question got answered already, but if you want to say something.
Yeah, it got answered. Thank you. Thank you for that.
Of course.
Sure.
All right, guys. Last chance. Any other question? I think it was a really great spaces. Thank you, Darren, for coming and helping us with all the questions that we had, and looking forward to the live stream and for the launch. Wishing you the best for a successful launch, like everything on Flare has been happening lately, and looking forward to try it out tomorrow.
All right. Awesome. Thanks, guys. See everybody tomorrow.
Happy day, everybody.
See you later, guys.
Thank you, John. Bye.